Good morning and welcome to ParkBridge Wealth Management Winter Webinar Series. This program is entitled Estate Planning for U.S. Clients Who Own Assets and/or have descendants in other countries, with a special focus on Israel. For those who don't know me, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. And you can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Avi Kestenbaum, who's partner at New York-based law firm Meltzer Lippe. Avi co-chairs the firm's Trust and Estates Practice Group and has a leadership role in the firm's tax-exempt organization practice group, business and real estate taxation, trust and estate litigation, and private wealth and taxation groups. Avi provides creative and sophisticated domestic and international tax, estate planning, and asset preservation counsel to CEOs of major corporations, ultra-high net worth individuals, multinational businesses, and large charitable organizations. He has also successfully represented many clients, including individuals, trusts and estates, businesses, and charitable organizations with the IRS and state tax audits. His practice places special emphasis on domestic and international tax and trust planning, big picture philosophy, family business succession planning, and effectively dealing with estate disputes. Avi has published dozens of articles in leading national tax, estate planning, and tax-exempt organization publications, and he's also a member of the Trust and Estates Magazine editorial and advisory board, where he's a chair of the Modern Practice Committee. He's also the adjunct tax professor at Hofstra University of Law. He's an ACTEC fellow and is recognized in Super Lawyers and Best Lawyers in America. Today, Avi will be speaking about estate planning for U.S. clients who own assets and/or have descendants in other countries, with a special focus on Israel. And with that introduction, I'll now turn the program over to Avi.
Thank you very much, Jonathan. I appreciate it. It's good to be with everyone this morning, and thank you to everyone for listening. Thomas Jefferson once said, "If ignorance is bliss, why aren't more people happy?" I take it by the number of attendees. We've got some items to learn, items to cover, and maybe we'll all be either a little happier after this webinar, or we will be more sad, because we will realize just how complex the international estate planning field really is. So I only have about 27 minutes. So my goal is to cover a lot of ground, to cover it quickly. Almost all of these topics could be seminars in their own right. And when I say seminar, I mean a full day or a full week. So our goal here today is to learn how to spot some of the issues. It's also understood we've got different levels in the audience. We probably have some experienced attorneys and accountants, and then we have some regular people who may not know much about these topics. So you'll forgive me that I'm trying to speak to everyone. And of course, there may be further programs at different levels, either with Jonathan or elsewhere, regarding different subtopics and categories. So some basics. A U.S. citizen. A U.S. citizen is subject to taxes on his or her worldwide income. Doesn't matter where the assets are located, subject to U.S. income taxes. Could be if there's a tax in another country, there's some type of double tax avoidance or mitigation. There are treaties, but potentially subject to tax on worldwide income. That's income tax. For gift and estate taxes and generation skipping transfer taxes, Similarly, a U.S. citizen is subject to these death taxes on his or her assets wherever located. So that property in another country, that vacation home, that business, whatever it is, if it's in another country, it is subject to U.S. estate taxes. Now, what about if somebody is not a U.S. citizen? What are those rules? Again, very complicated because we've got different rules for different categories. So first with income tax. So if somebody is a green card holder in the U.S. on a green card, or maintains a certain amount of time in the United States, sometimes referred to as the substantial presence test, that person is treated just like a U.S. citizen for U.S. income tax purposes. So subject to income tax on his or her worldwide assets. Again, they're a U.S. person similar to a U.S. citizen. If they're a green card holder or they pass the substantial presence test, which is a certain number of days that they spend over a period in the United States. However, the test for U.S. gift and estate taxes is a different test. It's not this mechanical green card test or substantial presence test. It's called the domicile test. And that is if somebody is in the United States presently with an intention to remain, that person is a U.S. domicile and could be subject to U.S. gift and estate taxes on their worldwide assets. And this comes as a shock to many people, where even if they do not have a green card and they are not in this country for, call it a long period of time, but if they're a U.S. domicile, they're here with an intention to stay, subject to U.S. Gift and estate taxes on their worldwide assets. Okay, now if somebody is not for income tax purposes, if somebody is not a U.S. citizen, not a green card holder, doesn't spend a lot of time in this country, and on the estate side, if somebody is not a U.S. citizen nor a U.S. domicile, so this person is not connected to the United States for income tax purposes, for estate tax purposes, what exposure do they have? And the answer is, well, they still have exposure because a non-U.S. person, no connection to the United States, could be subject to U.S. income taxes on U.S. source income. So on United States source income, they could be subject to U.S. income taxes. This could mean real estate investments in the United States. This could mean business in the United States. Again, we could have a whole seminar on that topic. And in terms of gift and estate taxes, this one is really tough for people to actually understand. But when a foreigner who has no connection to the United States even owns shares of U.S. stock, so somebody in Israel, Brazil, Italy owns shares of Microsoft, IBM, NVIDIA, because they were smarter than me and actually own shares in NVIDIA, and they die, they are subject to U.S. estate taxes on those shares of U.S. corporations. It's a shock to so many people, and they have a very limited U.S. gift and estate tax exemption. So unlike me as a U.S. citizen, or somebody who's a U.S. domicile who's actually spending and time and living in this country, who today has a $13.6 million estate tax exemption, this foreigner who owns a few $100,000 worth of U.S. stock could be subject to U.S. death taxes, or is subject with a very limited exemption. It's a shock to a lot of people. And in fact, I deal a lot with this issue. When foreigners have investments in the United States, whether it's shares of stock, whether it's U.S. real estate, and this is a big one. A lot of foreigners own apartments in New York City or invest in U.S. real estate. How do they structure it? Because if they don't do this properly, they will absolutely get hit with U.S. death taxes when they die. Not only that, there could be U.S. gift taxes on gifting of these assets. So the rules are complex. And in fact, not to make this even more technical, because we're really focusing on big picture, the rules are actually different for U.S. gift taxes and U.S. estate taxes. One example is, again, the shares of a U.S. corporation. If a foreigner gifts these shares, so gift shares of IBM or Microsoft, there's no U.S. gift tax. But if they die owning the shares, they could be subject to U.S. Estate taxes, and certainly they are subject. Not they could be, just a question of thresholds. When it comes to U.S. real estate, both gifting the real estate or dying with the real estate, subject to U.S. gift taxes and U.S. estate taxes, and that's why oftentimes it's better to structure this from the beginning, right from the time the investment is done, to have it owned properly in a trust or some other vehicle, because once the real estate is owned by the foreigner, it becomes very complicated to transfer it, because they're potentially subject to U.S. Gift taxes because they didn't set it up the right way. There are different rules for different assets. Too much for this seminar, like giving cash in the United States by a foreigner, tangible personal property, different rules for bank accounts and brokerage accounts. But it is something to be mindful of. And even life insurance. This is a shock, and I'll tell you a little bit about Israel. So very often people own life insurance in a life insurance trust. The reason being because if the trust owns the policy and is the beneficiary of the policy, typically the proceeds, if done right, will be exempt from U.S. death taxes. However, that is for U.S. purposes. Some foreign countries, including Israel, may actually tax the appreciation within that policy. So one has to be very careful, like if an Israeli owns a U.S. policy, maybe Israel's going to tax that. And even if a U.S. person like me, let's say one of my children is a beneficiary of my trust, and my child lives in Israel and is past his 10-year exemption period, that child could end up paying income taxes in Israel when that child gets money from my trust, even though it only held a life insurance policy. Again, we're not going to get into all the details, but just trying to make the audience aware that this stuff is tricky and to spot some of these issues. By the way, the U.S. Could also, for income tax purposes, tax a foreigner's ownership of a U.S. insurance policy, and that, to be clear, for estate purposes. So if a foreigner owns a U.S. insurance policy, it's possible that that will be subject to U.S. estate taxes, not income taxes. The income tax issue is in the foreign jurisdiction. Okay, some more basic rules. The unlimited marital deduction. So as we all know, one of the benefits of being married is that assets we gift or we leave at death to our spouse is exempt from U.S. Estate taxes. There's an unlimited marital deduction. However, that rule is only if the spouse is a U.S. citizen. So anyone who does not have a U.S. citizen spouse, even if they're a green card holder, even if they've been in this country for their entire lives, if they're not a U.S. citizen, there's no unlimited marital deduction, and there could be a U.S. estate tax on the first death. Some of you may have heard of a QDOT, a qualified domestic trust, where if I have a non-citizen spouse, I can leave assets in this QDOT, which will get the marital deduction and defer the estate tax until the second death. I will just tell you, I don't like QDOTs. I hear people say, the QDOT, yeah, I do the QDOT, non-citizen spouse. QDOTs are lousy. Firstly, there are a lot of rules with getting money out of the QDOT. Secondly, if the dollar amount in the QDOT is too high, then one needs either a corporate trustee, or the executor needs to, or the trustee needs to post a bond or a letter of credit. The reason being, the U.S. is worried, well, there's a non-citizen spouse. What if the money leaves the trust and we never collect our estate taxes when the surviving spouse passes away? So just to be clear, there is a deferral mechanism when a U.S. citizen is married to a non-U.S. citizen, called this QDOT, but it doesn't work so well. And certainly gifts. I can make as many gifts to my U.S. citizen wife as much and as often as I want. But if my wife is not a U.S. citizen, there are gifting limitations. I cannot be buying, loads of presents if I go over my annual exemption. Now, the annual exemption on a gift to a non-citizen spouse is pretty high. I think the last time I looked, it was maybe $170,000 a year. But the point is, be aware if a spouse is not a U.S. citizen, even if they're a green card holder, there are definitely some gift and estate tax ramifications. Okay, briefly on expatriation. Some of you may be aware of expatriation. We read about it in the news sometimes, where somebody wants to give up their U.S. citizenship. Why? Because they don't want to pay tax on their worldwide income, or they don't want to have death taxes when they die. So we've read about expatriation. It happens. Frequently wealthy people or people who just want to leave the United States and go to another country. Under the relatively new regime of expatriation, there's typically a tax on the built-in gain. So if somebody gives up their U.S. citizenship, there could be a tax on the built-in gain inside their assets. And there are rules, the size of the assets, the income. Somebody needs to be what's called a covered expatriate. But I just want to make one point here if this was not well known, which I don't think it is. A green card holder, not a U.S. citizen, a green card holder who essentially leaves the country and gives up their green card, or even if they don't give up their green card, but they haven't fulfilled, call it their green card requirements because they're spending too much time out of the country. If the green card holder gives up their green card, or maybe doesn't even give up the green card, is just not spending the requisite time here and could lose their green card, that is an expatriation. And even the green card holder could owe this tax on the built-in gain in their assets. So again, the point just to take is expatriation is not only for U.S. citizens who give up their citizenship, it's even green card holders who either give up the green card or just because they're not fulfilling the requirements, they're not spending the time here. Typically, they'll get a warning first, but it's just important to realize that does come up. Again, there are exceptions to the green card holder under the expatriation rules. Typically, they'll have to have had the green card or spending 8 out of the past 15 years. Again, just to make people aware. Okay, another sort of concept that I think a lot of people, they don't realize, because I get called about this all the time. One hears about U.S. citizens setting up trusts overseas, setting up trusts in the Cayman Islands and the Cook Islands and in Switzerland and in Liechtenstein and, just setting up a trust overseas. And the thought is, well, I'm going to avoid U.S. income taxes. And the answer is absolutely not. If a U.S. person or a U.S. citizen sets up an offshore trust, if there's even one U.S. beneficiary, that trust is typically going to be a grantor trust, pays U.S. income taxes. So there's no, oh, I'm a U.S. person, I'm going to set up a trust overseas, I'm going to avoid U.S. income taxes. No, you're not. You're going to pay U.S. income taxes as a grantor trust. Doesn't matter where the assets are located. If there are no U.S. beneficiaries of the trust, yes, then perhaps the trust can be set up where there aren't U.S. taxes to be paid. Similarly, and many of us have read about this, the games of having investment overseas and deferring U.S. income tax because, the investment is in a corporation overseas, the taxes are being paid over there, or there are no taxes being paid over there, it's in a lower tax regime, but I don't owe U.S. income taxes because it's in some type of foreign corporation. That regime has also been over for years, whether it's the controlled foreign corporation rules, whether it's the PFIC rules, whether it's GILTY, G-I-L-T-Y, T-I, it doesn't matter. There are enough regimes that when a U.S. person is investing overseas, that person is going to pay U.S. income taxes, regardless of where the investment is located. Yes, there could be some times where they're paying taxes overseas, so they get some credit to the U.S. taxes. Maybe if somebody owns a minuscule of investment overseas and there hasn't been any dividends paid, maybe there could be some deferral, but basically that's over, and it's something to keep in mind. Asset protection trust, sure. Maybe if somebody wants to set up a trust overseas because he feels or she feels there'll be greater asset protection, because if somebody sues, they'll have to go to the court in the Cook Islands or whatever jurisdiction to come after them. Maybe that's still viable, but even that, again, without this program is not on asset protection. I'm not such a big fan of that anymore either. Because a U.S. court could say a lot of things. Doesn't matter where the trust is located. If the U.S. court feels that the person could get to the money or has too much control over the money, again, this is not an asset protection program, but just in general, offshore trusts, income tax benefits if a U.S. person sets one up, not really, and even asset protection benefits. Maybe in certain situations, it's still a good idea, but be careful. And if somebody says to you, "Oh, let's set up the trust offshore," be very wary that that's a good idea. It might be a good idea. I'm not saying never, but just be careful. Okay, another big one, and I only have 9 minutes to go, which isn't good for me. Maybe it's good for the audience. Probate. So many U.S. people own apartments, real estate, other assets in other countries. Well, forgetting about estate taxes for the moment, which obviously there will be U.S. estate taxes on those assets. What about probate? I mean, when you die, how do the assets pass? The problem is the assets are in another country. So so if you're just going to have a U.S. will, it's a little bit of a problem, because the U.S. will gets submitted to the court here. How does your U.S. will get over there, and how do they understand the U.S. will? So it's problematic. I deal with this in Israel sometimes, where if somebody, a U.S. person, owns an apartment in Israel and they didn't do proper planning, the U.S. will has to be probated here. Then it has to be apostilled by the State Department, then submitted to the court there. The court there has to understand the English that it's written in. And finally, a year later, you're talking about maybe transferring that apartment. So oftentimes it's recommended, maybe not have ownership in your name, in the one who dies, or B, have a separate will in that country. It'll make probate easier to have a simple will in that country. It doesn't only apply to Israel, it applies to a lot of countries. But beware, probate is an issue. If you want that U.S. will to be dealing with the property in another country, it's not going to be simple. It could create a lot of headaches, time-consuming, expensive. Deal with it now. On that note, also keep in mind, while in the U.S. we have a step up or step down in income tax basis at death, maybe another country doesn't have that. So sometimes my clients tell me, "Oh, I want to own the apartment in Israel at my death to get the step up in basis. If it's ever sold, there'll be a new basis. We'll extinguish the gain." Well, yeah, but that doesn't help you, because Israel's not going to give you a step up. So if the apartment is sold in Israel, there'll be Israeli income taxes anyway, and typically there'll be a credit off U.S. income taxes. So there's no double tax. So the step up in basis is not going to help. As an example, another thing to be wary of if a U.S. person owns property in another country are the forced heirship rules. So in the United States, children have no automatic rights to inherit. I love my children, but if I want to, I can disinherit them. Spouses have certain rules, elective shares, where a spouse has some automatic legal rights in their deceased spouse's estate, but children do not. In other countries, it doesn't work like that, especially civil law jurisdictions like France, though many other countries have forced heirship rules. Whole list of them: France, Italy, Spain, Brazil, Japan, South Korea. In these countries, if you own property and you're in the U.S. and your U.S. will leaves these, for example, to your spouse or to, not to your children, one has to be careful, because the laws in those countries may force heirship. Your children may need to get a piece of those assets if you own the real estate directly. And once again, not once again, I say this all the time, you must have counsel in that country. Even if you have an experienced U.S. international estate planning lawyer, typically you're going to need to have counsel in that country, because no one can be an expert of their own country, a complete expert, and other countries as well. But be mindful of these forced heirship. Again, there may be ways around it. you own the assets in a company, so it's an intangible, but just be wary and be careful if you own assets overseas. Probate issues, B, forced heirship, where you may be required under the laws in those jurisdictions to leave that property to your children, or a certain percentage automatically to your children. You might not even be allowed to leave it to them in trust. They might have to get it outright. So just be mindful of that. This is the big one. Got 5 minutes to go. Unfortunately, if a U.S. person, for example, has children or grandchildren in another country. So again, I'm going to use myself as an example. Suppose I have children in another country. I'm going to pick Israel again because I know the rules there. My trust has been in the United States the entire time. The assets are in the United States. I'm in the United States. The trustee is in the United States. But I happen to have a child who's in Israel past his 10-year exemption. That trust, which has never stepped foot in Israel, the trustee hasn't stepped foot in Israel, my child maybe never even got a distribution, has reporting requirements in Israel, and taxes could be due in Israel. So be very careful. And it's not only Israel. I'm picking Israel as my example. But when you're a U.S. person and you have children or grandchildren in another country, be very careful that that other country is not going to require reporting and or taxes. And there are penalties. And again, Israel changed its rules about 10 years ago, where, again, no connection to Israel. The trust is here. I'm here, the trustee here. And because I have one potential beneficiary in Israel, there could be reporting, there could be taxes. Certainly on distributions, there could be taxes. But even if there hasn't been a distribution, again, this could be a topic in its own right. When a foreigner leaves an inheritance to a U.S. person, there also could be reporting. So when my uncle in Switzerland leaves me an inheritance to the United States, be careful. There could be reporting. There could be taxes. I'm going to speak even more quickly now. When a foreigner creates a trust and there's a U.S. beneficiary, also be mindful, because even if all the assets are overseas and it's a foreign trust, the trustee is there, the assets are there, I could be subject to U.S. income taxes and U.S. reporting. In fact, there are two main types of foreign trust where a foreigner creates it. One is a foreign grantor trust, where in that situation, there can't be U.S. income taxes. And that's where the foreigner can either revoke it, or it's only for the benefit of that person and his or her spouse. But any other type of foreign trust is called a foreign non-grantor trust, different than the U.S. grantor and non-grantor trust rules. And that foreign non-grantor trust, if there's a U.S. beneficiary, be very careful. There could be reporting, there could be taxes, there could be penalty taxes if money's accumulated and then distributed to the U.S. person. Other basic things to understand, if somebody has an account overseas, FBARs, disclosures, or when an account has $10,000 or more, be very careful. When you have rental income from a property overseas, are you reporting it properly? If not, you could get yourself into trouble. A really interesting one. Charity. So we know there is an income tax deduction if I give to a U.S. charity. If I give to a foreign charity directly, there's no U.S. income tax deduction. So sometimes if I want to give to a charity overseas, I give to a U.S. charity, and if the U.S. charity follows certain rules, that U.S. charity can give to the foreign charity. This is sometimes even the American Friends of model works like that. It doesn't have to be an American Friends of. A U.S. charity following certain rules can give overseas. However, different rule for the estate tax deduction. If I want an estate tax deduction in my estate, even if I give to a foreign charity under my will, there will be an estate tax deduction. And it's kind of neat because people who may want to give charity overseas, but aren't going to do it right now because they're not going to get an income tax deduction, they could do this in their will. And, it creates some nice planning opportunities, even for people that, may be, concerned with the United States. U.S. is a great country, not to be concerned. They could literally set up a foundation or some type of charity overseas, understood they're not going to get an income tax deduction, but if they left it in their will, they would still get an estate tax deduction. It's 9 o'clock. I'm sorry that this was so quick and brief. Maybe you're happy about it. I don't know. Obviously, I'm reachable with questions afterwards. I will say if you are going to ask me questions, I may not be able to respond right away, but certainly happy to continue the conversations. And thank you again, Jonathan, and for everyone in the audience for listening.
Great. Thank you so much, Avi. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out to Avi directly or myself where appropriate, and I'll be sure to include Avi's contact information in the follow-up email to this program. And as I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones that are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my winter webinar series continues on March 14th on the topic of women and wealth challenges and strategies for female clients, featuring yours truly, Jonathan I. Shenkman, President and Chief Investment Officer of ParkBridge Wealth Management. I'll send out an invitation to this program in the coming days. In the meantime, if you have a friend, colleague, or client who would like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line. I'll be sure to add them to my webinar distribution list. And my email is jonathan@parkbridgewealth.com. Second, you can follow all my work on Twitter and Instagram at Jonathan on Money. You can also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my new daily financial planning videos by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. And I thank you in advance for that. With that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.